Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I'm Christopher Cahill, your host. Later on, I'll be speaking with Jilliene Helman, the Chief Executive Officer of RealtyMogul. Why are we speaking with her? Well, for one reason is to find out why she left the bank job she had in order to found this very exciting and thriving real estate crowdfunding company, but we'll also speak of other things. Ms. Helman, I must tell you, speaks in paragraphs. One of those, yes. But first, let's talk about Duff Beer. Well, yes, Duff Beer. Remember, Duff Beer is Homer Simpson's favorite, and Homer Simpson once said of alcohol that it's, quote, the cause of and the solution to all of life's problems, end quote. Now that quote appears in the article in the Wall Street Journal, July 11, 2015, by Keith Hagee, entitled Duff Beer Tries to Tap Markets Outside Springfield. But I didn't need to read it there. That quote is imprinted in my memory. So it's a story about beer, but it isn't really about beer. This story is about intellectual property protection. Because once you are charmed by the Simpsons TV show, which is watched by billions worldwide, charmed in particular by the great beer brand within, Duff, which is as populistic as a beer brand can be. At one point, Homer says about Richard Nixon, that man never had a Duff in his life. You see what I mean? Anyway, the trademark was being pirated worldwide. People were always finding ways to create some beer and slap the name Duff on it and sell it, trading off of the intellectual property belonging to 21st Century Fox. The president of 21st Century Fox, Jeffrey Godsick, finally said if you can't beat 'em, join 'em, or in his words, once you see enough piracy, you are faced with two choices. One is deciding to fight it, the other is deciding to go out into the market with it. And so, against its desires, 21st Century Fox finds itself a beer maker. So this is really a story about intellectual property protection. Now, of course, 21st Century Fox is very wealthy and very powerful. If somebody makes beer off their name, they're not going to go hungry. But ordinary folks have trademarks. Ordinary folks have patents, and they've worked and created these things. And they should be rewarded for what they made. Or at least that's a premise that's familiar. It's part of the habitual way people in the United States think about their creations and their entitlement to the proceeds from selling their creations. Which, of course, brings to mind Abraham Lincoln. Just before he was president, Abraham Lincoln in 1858 and 1859 gave his first and second lectures on discoveries and inventions. Lincoln was particularly interested in such things. In fact, Lincoln is our only president to have a patent registered with the U.S. Patent Office. Lincoln's patent was number 6469, was granted on May 22, 1849, for a device for, quote, buoying vessels over shoals, end quote. He created the intellectual property while he was a lawyer in Springfield, and it had to do with a device for getting boats off the bottom of muddy rivers like the muddy Mississippi. Now, the two speeches I referred to, his lectures on discoveries and inventions, are available at teachingamericanhistory.org, which is also available at ashbrook.org, ASHBROOK.org, which is affiliated with, or which is a product of, the Ashbrook Center at Ashland University. I mention all this because that's where I became exposed to these, through their presence on the Ashbrook website, and through the teaching of a great man named Peter Schramm, who was a professor at the Ashbrook Center and its executive director for a long time. And why am I even going on about this? It's because we speak of entrepreneurship, we speak of investing a lot on this program and a lot out in the world and all over AccreditedInvestorMarkets.com and the other websites of the Financial Poise suite of websites. But all of this speech would be incoherent without a regime for protecting intellectual property, which itself would be incoherent without a political regime that protects a free market through reliable and open courts and popular institutions and freedom of speech, freedom of the press, and the encouragement of inquiry and the encouragement of invention. Lincoln's two speeches discuss the nature of speech by itself before there was writing as a way in which human beings took to inventing and changing their environment, beginning to conquer nature. Printing. Then came writing and reading, which helped quicken the creative aspects of speech, and printing popularized the creative aspects of speech and popularized and quickened the freedom of invention, even to the point of political invention, such as the American regime itself and its founders who self-consciously invented the institutions for free people, stable democratic and republican institutions, so that freedom and invention could be cultivated, made habitual throughout lives and across generations. These, Lincoln recognizes in his speeches, are conditions for human flourishing. The provisions for national laws for patents and protecting intellectual property were written into the original Constitution, and Lincoln's grateful for that, for they encourage, and Lincoln is grateful for that, and he speaks elsewhere in his 1838 speech on the perpetuation of our political institutions, also available, by the way, at ashbrook.org, about the problem of perpetuating such institutions, which he ties in his invention speeches to the habits of free and inquiring people. And those creations from freedom have to be monetized to join interest with ingenuity. We should know all that, but we should also not forget it. Taking this opportunity to remind us of it. And having done that, let's talk about making some money in real estate. We have here with us Jilliene Helman. Jilliene Helman, who has been on this program once before, is the Chief Executive Officer and founder of RealtyMogul.com, an online marketplace for real estate investing, which connects borrowers and sponsors with capital from accredited investors and institutional investors. As Chief Executive Officer, Ms. Helman is responsible for strategic direction and operations. She also sits on RealtyMogul's Board of Directors and Investment Committee. Jilliene has underwritten over $5 billion in real estate transactions and was previously a Vice President at Union Bank. Jilliene is a certified wealth strategist, holds Series 7 and Series 63 licenses, and has a degree in business from Georgetown University. And before I forget to say it, if I do, to find out more about Realty Mogul, go to www.realtymogul.com. So, Ms. Helman, I have an initial question. Why did you leave Union Bank? You could have been Executive Vice President by now.
I wanted to do something more entrepreneurial. You know, I always have had the entrepreneurial bug even since I was a little kid, and always wanted to go out and start my own company and put some change to the world in the real estate finance world.
Well, I have to say I have a lot of bank clients as a restructuring advisor, attorney, and, you know, especially the larger ones are awfully bureaucratic. I can't imagine how that must have affected you, but I guess you've already answered that question.
Yeah.
Well, let's then talk about different types of real estate investment. The reason I want to talk about different types of real estate investment is that I'd like to have it clarified for myself, and I'm thinking maybe that'll be helpful to our accredited investor listeners and other investor listeners. So let's just talk about the kinds of real estate investment that involve collective or pooled investments by multiple or even many investors. There's syndication, real estate investment trusts. What else?
Yeah, I think you can break it down in a couple of different ways. I mean, one way that I think about it is, you know, are you investing in debt or are you investing in equity, right? So are you pooling capital to buy shares of loans, or are you pooling capital to buy shares of equity investments? And then within each of those, you know, there's different buckets. There's mortgage REITs, there's equity REITs, there are non-traded REITs, there's traditional private placements and syndications. They can be structured as limited liability companies or limited partnerships, depending on the structure. So there's kind of a variety of different ways that you can get exposure to real estate. And then also within both debt and equity, you've also got property types. You have apartment buildings, shopping centers, office buildings, self-storage facilities, kind of a variety of different asset classes and transaction types.
Well, let's stay with one type and then the next. Let's stay with equity for the time being. So what is it an investor actually owns? I mean, the investor is told by his or her investment advisor, hey, this is a good idea. And so they come to own something of this kind. What is it they own and what is it they get when they own that thing?
Yeah, so typically the investor is going to be buying shares in an LLC. And those shares in an LLC are then going to be used to purchase shares of an entity that holds title to an underlying property. So let's say, for example, that we're going to buy an apartment building. That apartment building is going to be held in an LLC, and that LLC is going to be owned by potentially one or two other LLCs. So depending on the structure, an investor is buying shares in an LLC that really underlying owns a piece of that underlying property.
And that could be just one property that, they're interested in, maybe a local property that's of significant scope and they're hopeful will be profitable, or it could be properties across the country somewhere, couldn't it?
Correct. It could be a single property. It could be many properties. It could be a fund of properties. There's a variety of different structures depending on how that investor is looking to get exposure to the real estate markets.
Now, do you at RealtyMogul, do you involve yourself with collective investments in private equity groups or hedge funds that have real property strategies?
We don't. We're strictly investing in, underlying real estate. We're not investing in any operating companies like a private equity firm or a hedge fund that, would be then operating real estate.
Okay. All right. Well, then sticking with RealtyMogul strategies, which you know best, if I'm investing in a building, great. It gets built and it gets sold. Someday I get a payoff. But there are other ways to make money off of real estate. And I know I'm speaking at an elementary level, but I like to start with the simple and go to the complex. So what other ways are there to make money off of these investments other than the sale?
So the other way is through cash flow, right? Many of the investments that we look at investing in from an underwriting perspective will have cash flow, and there could be distributions for investors on either a monthly basis or a quarterly basis for their share of the cash flow. So say that a building, for example, distributes, 10% annualized cash flow, and that investor owns a certain portion of that transaction, they could be entitled to a percentage of that cash flow.
Is 10% a good number?
It totally ranges. You've got some properties that distribute, 3 or 4% cash on cash, all the way up to, 12 to 13, 14% cash on cash, depending on the transaction, the riskiness of the transaction, the location of the transaction, and the strategy of the transaction.
In highly competitive urban office environments, for example, if somebody's interested in investing in a mature environment like a fund that invests or a fund that purchases Manhattan real estate, for example, are you going to get a smaller number or a larger number for that percentage?
You're going to get a smaller number, right? Because if you think about just the risk-reward trade-off, if you're investing in Manhattan versus, a secondary or tertiary market in Texas, for example, you've got less risk in Manhattan theoretically. You still have risk, but you've got less risk theoretically. So in Manhattan, maybe you get a 3 or 4% cash-on-cash return, and in a secondary market in Texas, maybe you're getting an 8, 9, 10% cash-on-cash return.
And are we talking about a relatively simple syndication right now, or are we also talking about real estate investment trusts?
It could be either, right? In a real estate investment trust, you're probably not going to be investing in a single asset. You're going to be investing in a pool of assets. So there might be, 50, 100, 1,000 different transactions that make up that real estate investment trust or REIT. If you're talking about, a single asset syndication, maybe it's just one property in Manhattan or one property in Texas.
Well, it's one way of looking at it that if you're looking at a single property syndication, you might be attracted by the property value proposition. Whereas if you're looking at a REIT, which may have hundreds or even thousands of pieces of property, you're really investing in the management, aren't you?
I think you're investing in the management in both capacities, actually. I think you're investing in both capacities. I think you're investing in both the management and the real estate in both capacities. I mean, great real estate needs to be operated, right? And that operator is going to be the management team. I think the big difference is going to be diversification, right? If you're investing in a fund or in a REIT, you might have 10, 20, 100, 1,000 properties. If you're investing in a single asset, you've got exposure to that one piece of real estate. So I think it's more a question about diversity and less a question about, is management more important in one or is the underlying real estate more important in one? I think management and real estate is important in both.
I guess one of the charms of passive real estate investing is that you do not have to collect rents, fix up properties, and so on. And so you do need an excellent manager to maximize return and minimize costs for those things.
Correct.
Has a given type of real estate investment done better in recent years than others? I mean, is that question even coherent? I mean, is it larger office buildings, smaller office buildings, manufacturing facilities? What kinds of things have done better in recent years?
Yeah, I think holistically the market's recovered. So you've seen, strong recovery in all asset classes, right? Industrial, office, retail, multifamily. Multifamily is trading at some very, very high prices holistically right now. There's been a major comeback in the multifamily arena. The office market is also back in full swing when you look at what's going on in the economy and new job creation, and employers being able to expand their businesses and grow is obviously an essential part of robustness in the office market. There are niche areas in the industrial market that have gotten a lot stronger. If you think about, distribution facilities or plants like the facilities that Amazon was building or the facilities that other major retailers are putting in place to move away from kind of big box retail and more of a distribution plan where they're distributing, through either couriers or they're distributing, for example, with Amazon Fresh and their delivery of fresh groceries, right? They don't have any physical spaces where you can go buy from Amazon Fresh. It's all a delivery mechanism, so they've had to build out a lot of industrial for things like that. But I think it's been more broad-based, frankly. We've been in a pretty healthy recovery. So you've seen broad-based growth across all sectors of the real estate market.
Okay, we're looking only at private companies to which accredited investors have access for investing purposes that non-accredited investors do not, and knowing that your company deals with accredited investors and institutional investors, and looking at the now multi-year history of the Jobs Act, which expanded accredited investment opportunities in private securities, including securities that have to do with real estate like the ones we've been discussing. Has that resulted in an increased investment flow? I mean, can you perceive that it resulted in an increased investment flow into private securities and real estate?
Yeah, I absolutely think it has, just off the cuff, right, without having, true data to cite. But I think that if you look at it holistically, I think that the big change has been that you're seeing accredited investors that historically had never had access to or made investments in private transactions in real estate now being able to transact, right? They have access to an opportunity, and you're seeing more investors get involved. I think a lot of that actually has to do with press. So if you think about what the Jobs Act has created, there's been a ton of press and a ton of buzz around crowdfunding and crowdfunding for real estate, and it's educated new investors on the opportunity, right, on the fact that there are all of these private transactions that have, different risk profiles and different reward profiles that they can now have access to. So I think that you're seeing new investors that historically were not investing in transactions, investing in them, and an opportunity for more and more investors to see deal flow that they wouldn't otherwise have seen.
All right, so we've been talking about the equity side, although what you just said pertains also to the debt side. So you're investing in real estate debt, or as you put it, pieces of loans. How does that work? How does it appear? And what different kinds of loans might be involved?
So our lending business is predominantly two different buckets. One bucket is a fix and flip loan for a residential transaction, a single-family home, a duplex, a triplex, or a 4-unit property. And we're working with real estate companies or borrowers who are going to acquire that transaction, renovate it, so paint, carpet, maybe new electrical, maybe new plumbing, maybe new stucco or walls or cabinetry, depending on the scope of the renovation, and then they're going to look to resell that. So it's a strategy called fix and flip. So that's one of our loan products, and that's predominantly on residential assets. Our other lending product is on commercial real estate, so apartment buildings, office, self-storage, industrial, retail, where you've got a real estate company or a borrower who is looking to add value or renovate the property in some way, shape, or form. Maybe they acquire a property and it's, 75 or 80% occupied, and they need to do some refurbishing or spend some money to make the property look nicer, and then they can put tenants in and charge a higher rate to those tenants. That could be an example of something on the commercial lending side that we would do. So when we think about offering opportunities up to our investors, either individual investors or institutional investors, we've got kind of those two primary products, the commercial product and the residential product.
Well, let's just look at the residential product for a moment. When I think about fixing and flipping, I think sometimes more about if we may call it the bottom of the market, that is residential real estate in very troubled areas, because they're often priced very, very low, but maybe there's a significant upside to fixing them up. So instead of being a $20,000 piece of real estate, it's now a $90,000 piece. And you could do that. You can fix it up with a loan of $40,000. Is this the sort of market you guys are involved in at all?
Yes, but slightly higher numbers. So, our average loan is going to be in the $250,000 range. So, it's not kind of that $40,000 deal. It's more of a $250,000 transaction. But yeah, where you're buying ideally under market in something that needs to be renovated. You're renovating and then you're looking to resell.
Okay, and how do interest rates compare with, say, the mortgage rates that are quoted in the paper, original mortgages of good, well-made homes that don't need to be fixed?
They're going to be significantly more. So, and the difference is less about kind of fixing and more about the fact that these fix and flip loans are for non-owner occupants, right? They're not buying these properties to live in as the homeowner. They're buying these properties for investment purposes. So they can't get the same traditional financing that you could get if you were going to live in the property if you were an owner occupant. So your rates are going to be much higher as a result of this being an investor mortgage as opposed to an owner-occupied mortgage.
But the idea is that the lender is covered anyway because the loan will be less than the underlying value of the property today, and that the length of the loan will be very short. Is that right?
Correct.
Wow, it's a good business, I think. Well, now, and as far as commercial renovations, that's sort of similar in that the rates are going to be up there a bit, aren't they?
Commercial is slightly different because most commercial loans, or a good lot of commercial loans, are going to be for investor purposes, right? There are some owner-occupied commercial as well, but commercial is a slightly different market, right? Where your rates could be as low as 4% all the way up to 8 or 9%, depending on the level of risk in a transaction. So commercial is a slightly different animal than residential, but still a higher rate than a bank rate, for example, right? If you're going to go to a bank and get a mortgage, you're going to get a lower rate than you would trying to get a mortgage in order to do renovations or value add or something opportunistic on the property.
Well, I'll just use the term convenience as a convenience here, as you as being the provider of the loan or packager of the loan or middle person of the loan. Why aren't banks competing with you? I mean, this is a large set of loan business that isn't being done by banks and obviously creates opportunities for RealtyMogul and for accredited investors and institutional investors. Why aren't banks in on the action?
Yeah, so for some elements of these transactions, it's because of the duration. So our average fix and flip loan we write as a 12-month term. On some of our commercial loans, we're writing them anywhere from a 3-year term and beyond. And many banks don't want a term that short. Banks are very bureaucratic, right? So for them to originate a mortgage, it's going to be a 12-month mortgage. They don't have enough time actually owning that mortgage to make enough money on it that it makes sense for them, right? Because of how they're regulated, the regulatory requirements that they have as a bank lender, as opposed to a non-bank lender like us. So partially it's related to bureaucracy, it's related to the cost to produce, and it's also related to the cost of capital for a bank, right? Banks have very cheap cost of capital relative to other investors in the market. So if they're trying to mitigate risk, they don't have to go out and originate loans at 7, 8, 9, 10, 11, 12%, right? Some of them will and do, but their cost of capital is so much lower that they tend to prefer to play in the traditional owner-occupied space or the traditional stabilized commercial space.
Well, I should mention that the website, www.realtymogul.com, has, I think, compared to other websites of other online portals or online investment businesses, a whole lot of short articles that can guide people or introduce people to the investment types and many of the themes we're hitting on in this show. I want to congratulate you for putting that together. For example, you have some articles on P2P, peer-to-peer lending. How does peer-to-peer lending get together with using the term loosely, crowdfunding approach to investment?
I think they're probably synonymous, frankly. I mean, peer-to-peer means that you've got individuals that are funding individuals, and crowdfunding is a group of individuals pooling capital online to make investments. So they're very similar in that respect.
Ah, good. You see peer-to-peer all over the financial pages, and you're thinking, wow, that's interesting. What is it? You see crowdfunding all over the financial pages. You're thinking, wow, what is that? And here you are. They're the same thing in a way. a lot of crossover. Well, as far as just staying with investments in debt, it isn't simply a matter, and I know you're not suggesting it is, but it is not simply a matter of investing in entire projects or purchasing entire buildings. There are also available investments, again, to accredited investors and institutional investors in slices of loans or maybe even levels of loans, aren't there?
Yeah, absolutely. I think that, both sides can participate.
So that if you wanted to, let's say a safer investment would be in a package of senior loans where there are multiple levels of loans and very complex and large transactions. Or you might invest in a more risky mezzanine position if that sort of thing is available in a given debt instrument. Right?
Right, and it's really all about risk reward, right? The riskier a transaction, theoretically, the higher interest rate, you should be paid for that risk. The less risky transaction, the lower interest rate, you should be paid for that risk.
All right, well, then that comes to, perhaps you're already starting to answer the following question I have, which is fitting real estate into a portfolio. When I think of real estate, I think of it as one of the principal alternative investments, alternative to public securities and so on. Commodities are kind of very prominent alternative investment as well. Is real estate, like commodities, best understood as an inflation hedge or a counter-cyclical, or maybe we should just distinguish real estate from commodities entirely as far as a portfolio strategy? What are your thoughts?
Yeah, I think they're pretty different strategies, right? I mean, real estate historically has been discussed as an inflation hedge, assuming you are in real estate where the lease terms turn over fast enough where it can be an inflation hedge. So here's what I mean by that. If you are in an office building where the average lease term is 10 years, it's not probably a great inflation hedge, because if inflation moves up over 10 years, you're not rolling over those tenants. That being said, if you're in multifamily where the average lease term is 1 year, so a renter signs a 1-year lease in multifamily, it could be a good inflation hedge, because if there's inflation, things are getting more expensive, and in 1 year you can kind of reprice whatever you're charging for that apartment unit. So it can be an inflation hedge, but I think that certain types of real estate can also be countercyclical. As two examples, self-storage and mobile home parks tend to be pretty countercyclical. A lot of people will move into smaller space in the event of a recession or a down cycle, so self-storage tends to pick up. Similarly, mobile home parks, there's a lot of demand because it's a very cheap place to live, or relatively cheap compared to multifamily or, your own single-family home. Other types of real estate are not recession-proof, right? Office is another example where if businesses aren't growing and expanding and they're shuttering their doors and they're, having challenges staying in business, or they're going out of business, obviously you're going to lose tenants as opposed to grow tenants. So I think that you probably can't give broad generalizations around real estate, but you can look at some specific examples of things that are good inflation hedges or good counter-cyclical investments.
It must be part of the appeal of real estate investments to newer investors, maybe accredited investors who just became accredited investors, for example. It must be part of the appeal that everything you just said is perfectly tractable to anyone who's been sort of participating in common commercial life. Whereas investments in tech companies, for example, are really investing in a pig in a poke. You have no idea what they're doing. But we do understand that mobile home parks tend to do better when times get worse, and so on, what you were saying. So that must be a part of the charm. I noticed in some of the writings on RealtyMogul.com, there's a reference to diversifying within one's real estate investments. Let me just offer one probably erroneous way to do that and see what you think, and maybe you can identify others. Well, for example, if you had investments in North Dakota residential real estate right now, you wouldn't be doing as well if you put it all there compared to where if you had diversified it across the country geographically. Is that a legitimate way to think about diversifying within one's real estate investments, and what other ways are there?
Yeah, I think that's absolutely one way, and you can probably go a couple of layers deeper. So one way is a mix of debt and equity, right? So having some debt, some equity, depending on your risk profile, equity being riskier than debt traditionally. Another is geographic diversification, which is what you were discussing. Don't put all your eggs in one basket. Don't invest everything in North Dakota or California or New York or Texas. You can get, transaction-type diversification across debt and equity, get geographic diversification across the country, and you can also get property-type diversification, right? So apartment, retail, self-storage, office, mobile home parks. Maybe you have some cyclical, some counter-cyclical. Within each of those property types, again, you can diversify across geography. You can diversify across transaction type. So I think that, one of the beauties of online marketplaces like RealtyMogul.com is it's really allowing investors to get diversification and to build diversified portfolios where it was a lot harder historically, right? If you're an investor living in California, you probably see less New York transactions than you would if you're an investor living in New York, right, or vice versa. So, the beauty of online marketplaces is it can open up your eyes to investment opportunities around the country in different transaction types and in different property types.
Well, then it sounds like RealtyMogul might qualify as a disruptive technology. Do you see other disruptive technologies on the horizon for real estate investment opportunities?
I do. I see some really interesting stuff pretty occasionally being kind of at the intersection of finance and technology. There's some cool companies that are doing lease comps and crowdsourcing lease comps where you can see what actual leases in the building that you're considering renting in or the building that you're considering taking office space in went for. So there's a lot of transparency in the lease comparables that historically were, very, very guarded by real estate brokers or real estate professionals. There's some big data companies coming out around real estate, particularly commercial real estate, which has been a very opaque industry. So, yeah, I am seeing a tremendous amount of innovation around real estate.
Well, it's very exciting. Jilliene Helman, CEO of RealtyMogul.com. It has been a delightful program. Thank you for opening my eyes and those of the other listeners.
Great.
This has been Accredited Investor Markets Radio. I am Christopher Cahill. Thank you for listening. Accredited Investor Markets Radio is produced by Stephanie Strait. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.